All right, guys, let's go ahead and get started. So, what I want to do is we'll start out. We'll go through a bit of the price action from last week. All right, there's some things that will come up that will kind of revert back to maybe later in today's session, later in an additional session. I'm considering having a session tomorrow as well. It wasn't initially on the schedule, but I have some free time, so um, yeah, we'll go through that price action. A few things will come up, and as mentioned, you'll see them. You'll see us resort back to them throughout the lectures. Sharing my screen. You guys can hear me loud and clear, right? Just let me know.
Yeah,
Yes.
So,
loud and clear.
okay, cool, perfect, perfect. All right. All right. So looking at last week, if you were in last week's community call and you're here, you guys know what the expectations were. So we'll look at NASDAQ first. Okay. So we were speaking about order flow, all right, on that monthly chart, on the quarterly chart, and we understand. Let me get this out of the way. We understand that down close candle support and price, right, on the monthly chart. Okay. And we came into this week and we have this down close candle here. So we spoke about potentially seeing price maybe dig deeper into this down close candle, right? We don't know how far, but what we do know is that the current protocol is open, low, high, close. All right. And so that's what we kind of want to play against. Play in line with. And with that open, low, high, close, as always, we say open, low, high, close, right? That low points to a PD array, right? In this case, previous month's low. Okay. Going down to that weekly chart, we can see those equal lows here. All right. And then we'll get a little more fractal, even on the daily time frame, so on and so forth. All right. So at this current stage here, right, we've gotten that. This is kind of like Model X, right? We've gotten that inversion fair value gap or that change in state here, right? Closing above the bodies here, down. And then what we look for is a close above the body of this particular candle here. All right. Just going into the price action from the week on this, right? Monday, Tuesday, not a lot was clear. All right, but what I really want to speak about is this because this is something that's going to come up as we're going through this. So here on the 1 hour time frame, all right, we saw price run after leaving this discount array, higher time frame discount array, monthly OB, so on and so forth. We saw price run into this 1 hour fair value gap. Okay, and I want to speak about this because this is something that is very prominent, or at least my core initiative with this boot camp, which is us really solidifying or refining our approach in terms of change in the state of delivery, right? And more so what I'm calling the power of two, which is the second change in state of delivery. All right. I was actually on a call yesterday. I had a one-to-one call with my guy Martin, and we were speaking about this particular scenario, right, live on the call. And we were speaking about price running down into this 1 hour fair value gap. Okay. Now, what, as mentioned, what the entire goal here is for us to begin to see price. Let me take all of this off. Is to begin to see price through the lens of buy and sell programs. Every time you execute in the market, right, essentially what you're doing is you're playing a part of a buy or sell program. Now, what determines the trajectory or the terminus of that buy or sell program is the higher time frame or more parent order flow. Okay. So in this case, you can see a sell program here, which then converts into a buy program here. All right. But most importantly, remember that price ran up into the PD array, the 1 hour PD array here. All right. So Martin's getting ready to take more of a counter move or a counter trend move or counter order flow move, whatever you want to call it, down into this. Okay, now this is the important part. Martin's executions come up here. Okay, and the reason I'm pointing this out is because he's wanting to take a more advanced execution, right, in a counter trend move, but we have to know when to engage in certain ways and when to apply certain advanced techniques, right? When it comes to taking a more counter move, a move that's counter to order flow, I want to take a more conservative approach. And this is where we have to trust that the delivery of price is price trades from stops and efficiency, stops and efficiency, stops and efficiencies, right? There's always going to be opportunity. We get too antsy up here. And I asked him, because I understand what his normal model is and where he's most confident. He wasn't as confident in this trade. His stop loss was pretty sloppy. And what we come to understand is he wasn't as confident because what I'm going to be showing you guys throughout these lectures is when we begin to identify or truly hone in on the last phase, right? The last phase of accumulation or the last phase of redistribution, which we're going to clean up and clarify what the last phase is. What we learn or what we come to see is that you can get a lot more proficient with executions and direction by understanding that when the actual last phase here, and this is not just market structure, right? There's a reason this is the last phase. When the last phase is taken, all right, what increases confidence is when price takes out the liquidity, right? As we do here, price runs back up into the range, right? And what we're looking for is a failed swing, all right? Or what we can term as a second change in the stated delivery. All right. And so we spoke about this on the call. His executions were more premature. All right. But I'm always reminding guys that we don't have to get too antsy. There will be opportunity. Every time price takes out an external range move, right, or external range liquidity, right, there's always some push back into the range to seek out fair value, right? We take out stops, we're seeking out inefficiency. All right. So we were speaking about this move during this particular range right here. Okay. And that might not be super clear now, but I'm just giving you kind of the precept to it because it's going to be something that we speak more about, and then it's going to become a lot more clear. Chris is on this call. He saw a tremendous change in terms of his performance once we began to take this approach. But then one additional thing about this is if you are an older student, I talk to you guys a lot about that 50% grade, right? So that's projecting a move from point A to point B. Okay. And if this is the projected move, even before price gets here, right? Let's say that we're projecting the move, let's say we're sitting around here, right? We understand around that 50% grade, there's two things, right? Most times price will slow down, but also from a probabilistic or statistical standpoint, when price reaches beyond the 50% grade, right, probabilities increase in terms of seeing price actually run to the intended terminus. All right. And so I tend to call this the confidence level. All right. And it's taking your mind away from always needing to execute at the very pinpoint, the very smart money reversal. All right. Because your P&L isn't going to say you execute it at the most precise level or you execute it at below the 50% grade. It's simply just going to give you your P&L, right? It doesn't care about where you entered or how early you entered. Okay. But we see this move right after reaching into more apparent order flow, right? Then we see price turn around. And these are just service level points. I'm just going through this so that we kind of get the steam rolling. All right, so this is something that we spoke about. This must be news, but this is something that we spoke about earlier in the week, right? And then going through price action over the last few weeks. We were speaking about this in terms of seeing this as a potential dealing range. I'd like to see price run through these lows, right? But it is Friday, so we'll see what we get. What I was going to speak about with this though was seeing the second change in state here, seeing price actually run and close, seeing bodies close below this level. But we'll see how this plays out. USD CHF, same idea. All right, we were speaking about USD CHF running through these highs. Eventually, we should get to this level, but we have equal highs. All right, and we wanted to come into the week with an open low high close approach. Okay, so early in the week, we saw price trade down, and every single move, as mentioned, is a market maker buy or sell program. All right, so we're trading from point A to point B into this PD array, and then potentially up to point C. All right, now this week has been more of a range-like week, not a lot of great price action, not a lot of volatility. But hopefully we see that move. But what I really want to point out here is going back to the idea of the last phase of reaccumulation or the last phase of redistribution. Okay, this will be that last phase of redistribution, where as price clears that first pool of liquidity. All right, most times we're super antsy to get in on this very first, kind of like ICT 2022 YouTube model, where price goes here and we want to get in at this point, expecting this. All right, but in theory, the higher probability scenario is that second change in state, right? Seeing price trade and close through the down close candles that retest the initial order block. Okay, so I was speaking with somebody the other day about us solidifying this move by a body closure above these levels. All right, we haven't gotten it yet. You can see prices is kind of playing around. All right, and then just looking at gold from the weekly outlook, right? We talked about gold running through these levels. Haven't ran through the level fully just yet. All right, but the main key points here is just seeing that we ran down, we took out liquidity, and then you guys should notice, right, clear change in order flow, right? Down close candles really supporting price. Okay, so what that means is there's tons of opportunity within this range of price. There's tons of opportunity within this range of price, right? Once you guys see down close candles have really established themselves, and you can also notice the bullish dealing range right here. All right, so this range of price is balanced, right? Back and forth, back and forth. We take out sell stops, speed above the range, right? We come back down inside the range to fair value. All right, so there's opportunity in here, right? Creating that buy program. All right, so just brief insights, just to kind of get things flowing and allow guys to join. Let me make sure nobody is in the chat or in the waiting room, I don't think. All right, let's transition over into what the whole goal of today is. All right, so if you're on this call, if you are one of the guys that just joined us, or if you joined us at least a month ago, then you've already had the opportunity to go through the lectures. All right, so I don't want to make this a repetitive lecture. All right, obviously, this is the first day of us starting this little 7-day series. It won't be 7 consecutive days. It just will be 7 days total. But I don't want to make this repetitive in the sense that you have the recordings. I want to make this more engaging, right? I want you guys to really drop your biggest misconception related to the most foundational concepts. So today is laying the foundation, all right, or re-solidifying the foundation, all right, and then we'll progress into more refined topics, all right. So what I want you guys to do right now is please like drop your biggest misconception related to the most foundational concepts. Drop them in the chat. Give a thorough explanation of them, okay, and then I'll try to find direction based on those misconceptions, at least within reason of what the overall layout is for today. So additional initiatives are basically getting you guys to see the candle and delivery from inside out. All right. That is not just seeing the candle itself. All right. But understanding that that candle, right, there is a delivery, there's an open, there's a high, there's a low, there's a close of that candle. Right. And then once we begin to layer more and more candles on it, right, you begin to actually see the delivery. All right. From inside out. Okay. Also refining our understanding of the change in state of delivery. All right. I get a lot of questions. I use the body. Do I use the wick of the candle? All right, and I'm going to clarify that as we push throughout lectures. Also, power of two, right? Which is just it's just the change in state. If you're an older student, and it's model X, it's conceptually model X. But we're going to look into that second stage OTE, right? Which essentially is we have price sweeping here. We run out the level. Now we can see how price responds to the initial OB, right? And then we establish a second OB, right? So at this point, where probabilities really increase, okay? Um, Also, once again, talking about the last phase, providing more clarity on structure, right? We don't speak a lot about structure because we see it through a different lens, but I want to provide clarity on when I say the last phase of redistribution or the last phase of reaccumulation, understanding that it's the lowest point that leads to the most recent liquidity sweep. All right. So in this case, if we were going by structure or we were trying to find a structural shift, right, it would not be these lows. Reason being is because those lows could be used as inducement to allow price to run into the PD array, right? The ultimate PD array that lies here. Okay. So a lot of times, guys will just take any structural point. You'll get caught up into this move, right? Failure swing, and then price goes here. On the last phase, it's called last phase reaccumulation or last phase distribution for a reason. All right, this guy here. All right, and then speaking about beyond the 50% grade, right? Just understanding that that confidence level increases, right? The probabilities increase, taking you away from the notion that you always have to execute at the very pinpoint reversal, right? I know we're ICT students, and we get so caught up on the advanced techniques, but a lot of times you should not force yourself to fit a certain mold. And then just ultimately, guys, the market is a compilation of buy and sell programs, right? Every single move you take is a buy and sell program. Why? Because everybody on this call, every move you look at, it starts with the PD array. All right. It starts with the PD array. And in your mind, you're saying, hey, price is going to go to that PD array and trade away from that PD array. Well, all that is a buy and sell program. All right. So what we have to get in the habit of doing is it's understanding that there's going to be a clear distinction between the order flow on the left side of price, right? We always talk about trading the response, right? Trading the response from the PD array, meaning that there's going to be a clear distinction from the order flow here compared to what we begin to see transition over here. All right. And honestly, that has nothing to do with a macro, has nothing to do with a 90-minute cycle, right? This is simply just a universal concept, right? This is what I like to call the market's operating system. All of the other concepts, PD arrays, and all that stuff those are just like applications running on top of the computer's overall operating system, which is buy and sell programs. All right. So let's first start off with just basic foundations because there are newer guys on the call. The very first piece will be us just refining our viewpoint of the PD array matrix. All right. So initially, we only perceive these three arrays, right? Because these three arrays are the most significant. Everything else it kind of plays as a confluence to these three PD arrays. All right. So you have your old high low, you have your order block, and then you have your fair value gap. All right. Now, there's multiple arrays as mentioned. All right. But as I stated, the other arrays, they just heighten in probability when accompanied by an inefficiency, right? So basically, we have a breaker. If that breaker is accompanied by an inefficiency, right, it heightens in probability. Same goes for a mitigation block. I'm going to make who do I have? Chris, I'm going to make you the co-host. All right. If you don't mind, just let these guys in. right? And so what we got to understand is once again the most significant arrays: old high, order block, fair value gap. Okay, now PD arrays don't lose their relevance, right? The terminology just changes from one side of the curve to the next. Okay, so we have to combine the logic with order flow to find confluence that suits our ideas. So if we look at this scenario here, right, we see price trade up, right, we trade down, right, and essentially this is the sell side of the curve, right? We're seeing up close candles, right? This buy side delivery support the direction of price, right? And now we have price coming back up to the range after leaving an external range liquidity pool, trading back up inside of the range, external range liquidity pool. Now we're expecting price to go back up inside of the range, right? And then back out of the range, okay? All we have to understand is that every time price is trading back inside of the range, and we're expecting it to go back outside of the range, there's going to be a lower time frame buy or sell program, as we're seeing right here. All right. So price is trading back up, right, to some point of fair valuation. And we'll speak further about what fair valuation is, right, and to the point of fair valuation here. All right. And it's our job as traders to identify a certain response in price. Okay. So understanding that price, the only way price goes from point A here, all right, to point B here is order flow on a lower time frame, right, is going to shift to bullish, meaning that the down close candles, the buy side inefficiencies, right, are going to support price's direction. Once price makes it into the PD array, right, this is where we begin to look for those high probability pricing sequences, right, confirmed by a second change in stated delivery, right, which is simply just order flow shifting over. All right. So here, push up, fair valuation, and then we're looking for that order flow to change. All right, you're looking for that key distinction between this side of the curve and this side of the curve. All right, it's the same approach every single time, but just understand hold high, right? Order block, fair value gap. All right, those are your main arrays.
The HPPS, you're basically saying dealing range.
Yes.
All right.
Right. All right. So simple stuff here, right? Liquidity signatures, we all know above every high, right? Above every high is buy stops, below every low sell stops. We have our high resistance signatures here, right? Meaning that price runs, creates or engineers a high, right? And it takes out that high, right? We move away with speed. So what we mean by a high resistant signature, high resistant, meaning that price is going to be less prone to run back above this level, all right? Because we've already taken the liquidity above that point. In comparison, a low resistance signature, price engineers a high, right? We have buy stops above this level. It engineers that high. We run up. We try to take out the high, right? And then we see price move away with speed, all right? This is what we call layered liquidity. Okay, now in these cases, right, price is going to have an easier time running back through this particular level. All right, a lot of times we like to target these types of levels. All right, now the overall framework will determine if this level becomes something that price wants to run to or not. Okay, moving from there, another base concept, just basic knowledge. I know I'm moving through this because a lot of this stuff is basic. It's just understanding internal versus external range liquidity. All right, or internal versus external range move. If this were a range from range high to range low, all right, everything inside of this is considered internal range. Everything outside of this box, we know is external. All right. Now, the idea of internal and external is relative in nature because there could be a high right here. All right. Now, from this high, to this low, right, relative to the 2, above this high is considered external. All right, and then obviously below this low is external. So everything inside of those is internal. All right, moving on. All right, so now we'll speak about high and low resistant liquidity runs. So we talked about high and low resistant signatures and price, or liquidity signatures. Now I speak about high and low resistant liquidity runs. Okay. Now, a high and a low resistant liquidity runs are first framed from the premise of the current institutional order flow. All right, buy side, sell side of the curve. Okay. Once again, everything within ICT concept stems from buy side or sell side of the curve. Okay, everything else is just an umbrella concept rather that flows under this main idea. So it's best to trade in your low resistance liquidity run conditions. Okay, because that's where you'll see more speed. You'll get less of the back and forth. The trade I showed you guys earlier, or the trade idea that I showed you guys earlier, where we saw price trade down into a higher time frame PD array. This was Nasdaq, and then traded up, right? Ran into the 1 hour fair value gap over here. Okay, order flow is established as bullish, and my guy took a short, where he took a short trade. That would have been considered a more high resistant liquidity run, right? Which is why we saw more of price, moving back and forth. Your low resistant liquidity runs are basically price trading in line with the currently established order flow, right? Which is where you'll see more speed. All right, price will have a less challenging time getting to those areas. Okay, so just to give you more context, if you guys look at this, this is Euro USD from a long time ago, not too long ago, 2024. But if we look at price, right, are we on the buy or sell side of the curve here? This is a weekly time frame, buy or sell side of the curve.
Buy.
Yeah. So let's put it in the chat, right? We can put it in the chat. That's my apologies. But yes, we're on the buy side of the curve, right? We know that because down closed candles are supporting price. Okay. But what I want to bring your attention to is this high to this low, right? Or at least this range, rather. Let me go back. All right. I want to bring your attention to this range. Okay. Now, what we're going to see from this point A down inside of the range to point B, okay, is we're going to see order flow shift on a lower time frame from here, okay? But what we have to keep in mind is that the low resistant liquidity run is price attacking these highs, right? Price is attacking highs. Why? Because order flow is bullish, right? So running back towards the highs is considered my low resistant liquidity run. Every retrace back inside of the range is considered my high resistant liquidity run. All right. Now, that does not mean that I cannot trade the high resistant liquidity run, which is here. What that does mean is that I have to be cognizant of the fact that the deeper I get to parent order flow, or the closer in proximity I get to parent order flow, that is where I need to hold up a little bit, right? I need to pump the brakes in terms of me wanting to continue to short within this area. I need to start prepping myself to look for bullish opportunity. Okay. And the reason this is important is because of this. If I asked you guys, if I said, hey, is this a bullish or bearish scenario right here? Right? What are you guys giving me? Is this a bullish or bearish scenario? Just with this context, right? Okay. Great answer. Okay. All right. So a lot of old students on here. Okay. All right. And the guys who are saying bearish, right? Okay, cool. All right. Now, the common answer would be, hey, this is a bearish scenario. All right. But the more advanced or expert, I don't want to say expert, but the wiser answer, right? The more seasoned answer is that this is neither. All right. This is determined by the higher time frame or overall framework. Because a lot of times, let's imagine that you see price provide this type of context. All right. It gives a buy side sweep. It gives a run lower. All right. What deems this as bullish or bearish scenario is where this occurs within a certain buy or sell program. All right. And then also within a high or low resistant liquidity run. So if this signature in price were to occur somewhere within this range before even reaching into this PD array, right? Then we see this as it's higher in probability that we continue to go lower, right? Because we're still higher up in the range. There's a PD array right here that needs to be reached. If this scenario occurs deeper inside of the range here, where we know we're resting right on top of parent order flow, all right, then we begin to see this as potentially a bullish scenario, right? Because what most will do is we'll see the liquidity sweep, right? You'll see buy stops run, sell stops run, and then we'll see a fair value gap inside of this range. And we're wanting to trade the fair value gap on the right side of price. All right, we want to go short. Okay, we go short, but then what happens is boom, failure swing. So now you're confused. You're saying, oh, well, this scenario should work. I was told that when I get a liquidity sweep and I get an expansion, that this image should work every single time. No, no, the probabilities are determined by where this occurs in price. All right. So we're going to see as price gets down here, you're going to get a signature that's just like this. All right. And then price actually goes the opposite way. Okay. So it's just being conscious of where you are. And is this the high resistant liquidity run? Is this the low resistant liquidity run? Okay. So looking at the range here, we got to see this is that weekly down close candle. All right. So this is that weekly down close candle that we saw on the higher time frame. All right. And this is I believe this is my 4-hour time frame that we're looking at right now. Yeah, this is our 4-hour time frame right here. Okay. And so we see price trade up. And remember, we should see everything as a buy and sell program, right? Every single move is a buy and sell program. I see buy side of the curve here, right? We run into a higher time frame PD array it's not shown in this chart or in this frame, right? And then we see a transition to the sell side of the curve here. Okay, so we take out last phase reaccumulations. We start to see up close candle support and price, all right? And then this is that 4-hour fair value gap, all right? And then we're seeing the up close candles, as mentioned, these guys are supporting price, all right? But all the while, we're understanding that this is the high or low resistant liquidity run. It's all good. Is this the high or low resistant liquidity run? This move from point A here down to point B here. All right, let's get a few more answers. Okay. Okay, exactly. So this is the better answer, right? In this lower time frame, right? These would be considered, because remember, it's all relative. The lower time frame, this is considered, yes, this is the low resistant liquidity run, right? For this particular time frame, right? But we have to keep the overall framework uh, in mind because the weekly down close candles are resting here. All right. So essentially, from a more macro perspective, this point A to B is our high resistant liquidity run. All right. But from the lower time frame perspective, we're going to see it as, yeah, this is the direction of price, but it's just playing is playing its part within the overall high resistant liquidity run, because the true low resistant liquidity run is for price to come back here, right? Notice there's speed. Here, there's more of resistance. There's more of a challenging time for price to trade back to this area, all right? There's more institutional sponsorship for price going back here. Granted, this is CPI, all right, but news follows price, all right? We know that oftentimes news comes out just at the right time, okay? Now, once we see price get down here, something else that I want to point out to you guys is this scenario right here, okay? You see a liquidity sweep, and then you see price run away, okay? Now, this is a 4-hour chart. Somewhere on the lower time frame, there has to be fair value gaps inside of this candle that look pretty decent to take shorts from, all right? Remember, this is that image, all right? We're seeing buy stops, run away, and we're thinking, all right, I can trade the OTE from here, and then price should go lower. What actually happens is you trade the OTE from here, it goes lower, and what happens? Failure swing. Boom. Why? Because high resistant liquidity run, right? We're resting on top of parent order flow. Now it's time for price to transition to the buy side of the curve. We go here, sell side of the curve, up close candle support and price. As we get closer to this area, any type of bearish context is going to be lower in probability, right? This initially looks like bearish context. It is lower in probability. Why? Because you have a higher force, right? A more superior force resting to the left of this lower time frame context. Okay, so now order flow shifts over. We begin to see the down close candle step in, right, and support price. And then, of course, CPI steps in, and it just gives us a lot of speed after that. All right, so we'll zoom out of this. All right, so essentially, just to kind of clarify that, high and low resistance liquidity run, essentially trading with the trend or with order flow or against the trend or against institutional order flow. All right, we'll go through this example fairly briefly. All right, same idea. Okay, you can only imagine that this move from point A to point B, that lower time frame order flow is bearish, right? But bearish until what extent? If I was to measure this range and go from high to low, right, I'd say premium or equilibrium is probably here. This would be my discount array. This would be my discount array. All right. So that bearish order flow, yes, these bearish contexts of bearish signatures and price, right? They're increased in probability until we begin to get closer to the more apparent order flow, right? Because at this stage, down close candles are still supporting price. Down close candles supporting price, right? So I need to see this move from point A to point B as just a buy program setting up, right? It's not a true or official trend change. It's just a buy program setting up. Now, if price were to run through these levels here and then create a second change in state of delivery, now we know, all right, there's an official shift in institutional order flow. All right. So let's erase this here. All right. So let's go in and let's study what this looks like from point A to point B, back up to point C. All right. We'll also try to find what happens around the 50% grade. All right. Let's go to this image right here. Okay. Now, we're seeing this move, right? And we know that this move is the high or low resistant liquidity run. We'll come back and answer that. All right, this move from point A to point B, high or low resistant liquidity run. But let's give the overall perspective. David. Yeah. So overall, what's most important, right? What's most important, right? Because the higher time frame is always going to take precedence. All right. So this is the high resistance liquidity run, which means I need to be conscious of where my parent order flow is. Why? So that these types of moves, liquidity sweep, market structural shift, I'm not tricked by these moves, right? What I'm truly looking for is a swing low fractal to form. Okay. I'm looking for the swing low to form, not more bearishness, not this. This is lower in probability now because we're resting at parent order flow, right? We're in a high resistant liquidity run. I'm looking for the failure swing. All right. And then we begin to see bullish order flow is established. Right. Down closed candles are supporting price. Back and forth, back and forth. Right. And then we see price run to its official terminus. Let's try to measure the 50% grade. Not sure what happened. All right. So around 50%, typically what we see is offset redistribution or offset reaccumulation. All right. So we have highs here where price takes out liquidity, and then we see a run lower. All right. And this is a daily range right here. All right. So that is your high and low resistant liquidity runs. Okay. Just to give you guys more of a diagram type of photo. Higher time frame, down closed candle supporting price, right? We know that price trade stops to inefficiency, stops to inefficiency. Okay. Potentially here, we've ran out stops. Now price is coming back inside of the range to seek out fair value, right? To rebalance the range. Okay. We get down to a point of rebalancing this range. And when I'm saying seeking fair value, right, which maybe I'm early to touch on this topic, but when I'm saying seeking fair value, see this delivery as this, right? Or when I'm saying rebalance the range, right? This down close candle and this up close candle create space or gap in price from here to whatever is up here. Trading back down, all of this delivery, right? Now this range is pretty fair, right? Buy side, sell side is evenly distributed. Okay, we've reached into fair value. The order flow on the lower time frame transitions to bearish. All right, but we understand this is the high resistant liquidity run. The low resistant liquidity run is back towards these highs. Okay, I'm going to have a much higher probability trading the low resistant liquidity run. Right, the price movements are going to be a lot more fluid. Right, so just remember, buy side of the curve, down close candle support price. Right, sell side of the curve, up close candles will support price. Okay, now getting into the market efficiency paradigm, or a way in which you should understand price, right? This is how you should interpret price. Okay, so it's not just looking at price, looking for market structure, right? It's looking at price and understanding that there's a cyclic flow to price. All right, so the markets trade buy stops to sell stops. They create inefficiencies and they seek to rebalance those inefficiencies. And then that cyclic nature of price starts over. Right? So give you guys an explanation. Down close candle, down close candle. And let's say that this market it trades buy stops to sell stops, right? Buy stops to sell stops, right? We transition over, buy stops to sell stops, create inefficiency as we're doing it, right? that flow is going to continue from PD array to PD array, right? We reach a point of parent order flow, okay? We trade sell stops to buy stops, right? Which is a change or reverse in trend or a change in order flow. Now we go back to inefficiency, buy stops, inefficiency, buy stops, inefficiency, buy stops, inefficiency, back up to this overall point. All right. So just remember, in a trending market, right, when price is trending, right, when our direction is set, we're going to see price trade from stops to imbalance, stops to imbalance, stops to imbalance. Okay. Once we meet that parent order flow, right, or that high resistance signature, as we just spoke about, that is where you have that PD array sitting here, right? Let's say the down close, I'm using blue to convey this, but let's say the down close candles are supporting price, stops, inefficiency, stops, inefficiency, stops, inefficiency, stops, inefficiency, right? Remember, this is the high resistance liquidity run. What I'm looking for is for those imbalances, right? Those sell side imbalances. I'm looking for those guys to no longer support the direction of price. All right. So I'm looking for price to go from sell stops, right? We clear out the imbalance. And if price closes through that imbalance, which we all know about the inversion fair value gap at this point, but just adding more context, if price trades stops to inefficiency and it gets to a point where it reaches parent order flow and it says, I no longer care about the inefficiency, right? Then the only thing left on the table is stops. All right. So when we go stops to stops, after reaching into a PD array, all right, this is a sign that order flow has shifted. Okay. But the whole premise of this 7-day mastery, right, once we get over the foundational concepts, is to help you guys to realize that it's not this point is okay. This point is fine. And we all know there's more advanced entry techniques for this. All right. But you don't have to force yourself to always execute at the earliest point. There's a lot of profit or a lot of proficiency that can be found even after price has made it 50% of the way. All right. So what the point I'm getting at is we see this very first point at which price runs through this last phase of redistribution. All right. Most times we want to execute around this area here. All right. However, this is that first change in stated delivery. Okay, so what I mean by that is this is that first moment in which, let's say there's a series of down close candles, right? There's an imbalance right here, and then we see price trade higher, right? And we were seeing stops, inefficiency, stops. We're looking at this inefficiency to see if this higher time frame PD array is going to force a new behavior in price. We see, oh, the inefficiency has been cleared. All right, that hasn't happened before. Now we see price trade up and it closes above the bodies of this series of down close candles. That is my first change in stated delivery, right? Now, looking at this move from this point A to point B, right? This move is that first OTE scenario. All right. Now, if I were to grade these scenarios in terms of probability, I'd say this first OTE scenario might be like, I'd say 33%, right? Whereas after the second OTE, right, immediately, this maybe we can say, and just don't quote me on the math here, but let's say around 60% in terms of probability that direction is sustained. All right. So if we look right here, we have the down close candles that trade back inside of this range. And there's no time frame. This is not time frame specific. This is just price, right? We see price trading back up. The moment we trade and we close through here, now we can factually say, hey, the down close candles are supporting price. How do you know that? Well, because I saw price take out liquidity, right? We took out liquidity. We traded into a down close candle, right? Which is this series of candles. If you scale up a time frame, this is probably going to be one candle. So it's delivery. We trade into the down close candle, and this down close candle forces a second change in the state of delivery, right? The second change in the state of delivery is price factually telling you that, hey, order flow has shifted, right? So after we responded to the PD array, right, price tells you, hey, order flow has shifted. This PD array has caused price to shift back into bullish order flow. All right. Now, this is that second change in state. It's what I'm calling like power of two. Okay. Because it's the second OTE. Right. Executions either come from the very closing above this level. This depends on your R system. If you have a higher fixed R system or lower R system, that would determine whether you execute here or not. But today is not about executions. But ultimately, at this point, this becomes your second stage OTE. All right, which is where there's higher probability that you get direction right. The reason I say that is because this area here, let me back up a little bit. All right. A lot of times what we see is this area here, once price clears out these highs, all right, we'll see that that move just becomes a liquidity sweep. So what I'm saying to you guys is you can take a slightly more conservative approach, right, where it heightens your proficiency. And you can say, hey, I want to see how price responds to here. I want to see the second change in state of delivery, right? I want to see that second down close candle or second series of down close candles where price trades through the opening price of those candles. All right. And at that point, order flow is truly established. Okay. So let's move from that. And obviously, we be in the low resistant liquidity run. Okay, so same diagram here. Just looking at, we're going to look at ICT's price delivery cycle, the way that he puts it, and then we're going to look at the way that IFTX puts it. All right, so we know that there's 4 phases. You have your consolidation, your expansion, right? And then price either goes from consolidation expansion to reversal or consolidation expansion to retracement. Okay, what determines this is order flow. Okay, so if we can put this back into context here, right? If price gets here and we go into consolidation, right? This would be considered an expansion, right? Okay. Now, expansion against the high resistant liquidity run, right? Down into parent order flow. Remember, the higher time frame down close candles are supporting price. Expansion, right? Reversal, right? In this case, we go consolidation, expansion, reversal, retracement. Okay. Now, this is where it gets good because everything is fractal, right? At this turning point, let me just go back through this. Remember, you've had consolidation, expansion, reversal, all right? This move is the retracement. Well, but we have context, we have narrative, we have framework. We understand why this is happening, right? Why this should be happening. Because it's reacting to a higher time frame PD array, which is in alignment with the parent order flow. So now where this uh where this is or where this gets good, where we have to become masters of our craft, is now understanding that within this area, the same way we just saw that price delivery cycle from a more macro perspective, right? This move from this point A down inside of here, this retracement, where we're expecting it to go from retracement back into a reversal, the overall fractal literally starts over, okay? Because we're at a PD array. So we talk about trading the response, trading the high probability pricing sequence, which we're going to move into next. What you'll see is price will go consolidation, all right? And understand this, when we're saying consolidation, right, this is a matter of semantics, but it's not, it doesn't always have to be a tight range, all right? And the reason that I basically I use a separate terminology is because when we say consolidation, we all think, oh, it needs to be a consolidation, right? Especially if you're a beginner, you think you're looking for a consolidated range. What it really means is that price is engineering liquidity, right? It's creating a swing low fractal. It's engineering short-term lows, right? Consolidation, expansion, intermediate term low, reversal. Buy side imbalances come into the market. Guess what? Your retracement, right, in the next little continuation or reversal phase makes a second change in state of delivery, right? Order flow, down close candle, up close candle. Now we're retesting this down close candle. And then price says, oh yeah, those down close candles are strong enough to support price. Oh wow, I reacted to a PD array. Right, so we just traded the response. We didn't take the PD array for face value. We just traded the response, the second change in state, right? And now from there, this is the low resistant liquidity run. We should begin to see speed. Okay, zooming back out. Now, so ICT puts it in the context of consolidation, expansion, retracement, reversal, right? But what we utilize at X is the high probability pricing sequence, which is understanding that price, right? There's a cyclic nature of price, right? Price is always moving from stops to inefficiency. It's always moving in the sense of a buy and sell program, buy and sell program, buy and sell program. At every single point here, there's a change in the state of delivery. There's a shift in institutional order flow. All right. And there's a very consistent fractal, all right, that solidifies that change in the state of delivery or that shift in institutional order flow. Okay. And that fractal happens to be the high probability pricing sequence, right? So it's price reaching into a PD array, price reaching into a PD array, right? And there's some magic that happens up here. Okay, but we don't have to execute up here, right? We can just become very proficient in identifying the magic that does happen. So as I mentioned to you guys, every single move is a buy and sell program. Price moves up to the PD array, something occurs up here, high probability pricing sequence, and then it is solidified over here. Price trades back up into the range, same idea, right? Buy side of the curve on the lower time frame, sell side of the curve on the lower time frame, aligning with the higher time frame. Okay, so what occurs at these points in price, right, is this fractal. Okay, and this is like the single most important fractal that you can study when you're looking into these concepts. But it's just as simple as this: engineer, neutralize, rebalance, redistribute. Right? Why? Because in looking at this fractal, there's so much that I can derive from this. Okay, this is a sell program, right? This is a breaker. This is a failure swing. This is order flow shifting over. This is a change in state of delivery confirmed by a second change in the state of delivery. right? It's OTE, right? The entire ICT umbrella lies within this one diagram. Okay, this is the operating system. If I were to zoom into this diagram, then there are multiple applications that run on this operating system. What do you think happens up here? Before price turns around, it goes back through that same cyclic nature, right? Engineer, neutralize, distribute, rebalance, redistribute, right? Created a swing high fractal to turn price around. Here it's going to trade stops inefficiency, stops inefficiency. Oh, we just ran out of PD array. Now we might see price turn around temporarily. Stops inefficiency, stops inefficiency, stops inefficiency. We reach up into fair valuation. This here creates an up close candle. This creates a down close candle. Wrong color. This creates a down close candle, right? Fair value is here. Okay, so lower time frame, the lower time frame price action is going to give me lower time frame down close candle support price. We run up into the up close candle. We have the opportunity to see if engineer, neutralize, distribute, rebalance. So remember, first change in state followed by second change in state. Order flow is confirmed. Up close candle is going to rest here. Up close candle is going to rest here. And then we'll start to see speed. All right. So now let's back up and let's go through the phases of the high probability pricing sequence. I know you guys are probably putting stuff in the chat. I promise I'm not ignoring you. Yes, exactly. All right. So engineer, right? So engineering, I need to charge my guys, give me 1 second. Let me place this on the chart. All right. All right. So going through the phases of a high probability pricing sequence. All right. Price engineers, right? This is where we're engineering liquidity. Price neutralizes, right? So engineering, most times this will happen just above or just below a PD array. In this case, we're looking at it happening just below a PD array, right? And it doesn't have to always be below, right? It could be just before the mark of the PD array. Or actually inside, which is why we say, hey, never take the very first swing into an array, right? We engineer, then we neutralize, right? We take out the liquidity. Remember, even in that neutralizing phase on a lower time frame fractal, there's going to still be the same engineer, neutralize, distribute, rebalance, redistribute, right? But just looking at the overall fractal, engineer, neutralize, taking the liquidity, distribute, right? We engineer, we neutralize, then we distribute. We move away with speed, okay? Earlier, I told you price trades from buy stops to sell stops. In doing so, it creates inefficiency. We create an imbalance. Now it's time for price to trade back up and rebalance that range. We're trading to fair valuation. Once we get there, right, everything is fair. Now it's time to redistribute. Boom. At every single one of these little turning points, this point, this point, this point, there's going to be lower time frame, high probability pricing sequences. All right. So why is the high probability pricing sequence important? Okay. Well, we're talking about the turning points, right? We're talking about the turning points in price. So I gave you guys this little diagram. They're talking about these turning points, right? Where price is going through those fractals. Well, when we look at this fractal, Okay, for those of you who are new, when we look at this fractal, let's say this delivery is down close candle, and this delivery is up close. All right, and then you have that delivery is followed by down close candles, and then we have that delivery followed by up close candles. All right, so essentially what you're getting here, right, is an order block. So the high probability pricing sequence itself, it creates an order block that is, or a change, which is the order block is the change in state of delivery, right? But then what it does is it solidifies the initial order block, okay? Because price rebalances and redistributes. Okay, so when we talk about seeing price or seeing the candle inside out, we're talking about actually seeing the delivery. All right, so every one of these turning points, you're going to get a high probability pricing sequence, which can translate into a change in state of delivery, which translates into your order block. Right, but the point that I'm emphasizing is the second change in state, right, or power of two. Okay. All right, just understand this. Markets will trade from fair value to discount, discount to premium, premium to fair value, fair value to discount, discount to premium, premium to fair value. All right. What's most important in that is the fact that to go from fair value to discount, right? In this case over here, we trade fair value to discount. In order to do so, in order to shift, there has to be a change in the state of delivery. There has to be a high probability pricing sequence. There has to be a shift in institutional order flow, even at the most fractal scale. All right. So all you're doing is repeating. It's the same. It's the same delivery, the same conceptual approach. We're just repeating it each and every time, right? Within reason of time frame, within reason of parent order flow. Yes, bodies of the candles, right? I can show you time and time over, but we'll talk about that because a lot of times I get guys that will argue back and forth: is it the wick or is it the body? And if you've been with me before, you know that I'll say it's not about either. It's about whatever equation you use consistently. All right, so let's move from that. Let's talk about balanced price ranges. Okay, so a balanced price range is a range in price where buy side and sell side delivery has been evenly distributed. All right, so these areas will hold as strong areas of support or resistance, and they can also be used to frame future ideas about price. Okay, so it's never just about the concept itself, it's how does that concept fit within reason of the current market. All right, so even going back, what I mean by that is going back to when I was showing you guys the scenario from Euro USD, when we were talking about price trading down into that high resistant liquidity run, and we saw in our lower time frame as price had gotten down deeper inside of the range, right? We saw price kind of give us a little move like this, and then it ran the low. All right. So it created a balanced price range, and then it traded above that balanced price range, gave a failure swing too. All right. So it's not just the concept, it's more so of where are we seeing that concept relative to the current market. In this case, it makes a lot of sense that we would get a balanced price range here to be able to push price higher. Right. And that'll make more sense as I continue to explain. So when we talk about balanced price ranges, there's often two, like kind of like two visuals. All right, one being this, where we see price move down inside of a PD array with speed, and then we move away with speed, right? Where there's two fair value gaps on each side of price. Okay, we understand that these areas will hold as pretty strong areas of support or resistance. Okay, then the more prominent balanced price range, right, is where we see price efficiently traded. Okay, so we look at this box, we're seeing down close candles here, up close here, down close here. Everything is balanced. All right, we go up close candles here, down close candles here, up close here. Everything is balanced. All right, we push up. We have up close candles here. So everything within this area of price is balanced and efficient. And a lot of times, what you guys will see me do is I'll find the most consistent area where bodies are not really reaching above price, right? Where there's a consistent area of bodies, and I'll kind of mark out that area. Okay. Now, so order blocks create at fair value mark. Okay, cool. So what's significant here about balanced price range is when you see a balanced price range, order blocks that are created at fair market value, all right, tend to hold. Now, if they are traded through, meaning this, if they are traded through with speed, all right, then they become even stronger breakers. All right. So going back to that idea or that concept of a high probability pricing sequence, this is where price in this range is engineering liquidity, right? Creates a balanced price range. We trade above the range, all right? And obviously this downside delivery right here from this point to this point back up is going to create an order block. Okay, just to draw it out, there's going to be a down close candle followed by an up close candle. Boom. All right, so order block near or around fair market value of that range. Okay, if we trade with speed back through that area, right? Now that order block, right? It becomes heightened, even more heightened. Now it's just a breaker, right? Becomes heightened in probability. Okay. All this is, once again, it just points back to the high probability pricing sequence. Engineer, neutralize, distribute. What do we expect next? Rebalance, redistribute. All right. But now we know that, hey, this is a balanced price range. Okay. We don't expect price to trade back beyond fair market value. So essentially what's happening here is if everything is efficient and we leave this range, we know that the only thing price is worried about is running to buy side or sell stops and then rebalance in certain ranges, right? And it continues within, that cyclic flow. Okay. But if this range is efficient and we leave the range, we don't expect that there's nothing that price needs to rebalance here. So if we leave the range, it's almost like, all right, price has chosen its fate. If we see price turn around and run back through the range, all right, essentially what price is saying is that this is a false move, right? Rarely will we see price trade back and forth through a balanced price range. All right. So in these scenarios, it becomes really high in probabilities that we'll be here and then we'll be here. Fair market value, and then we're back out. Okay. So now what is fair value? Okay, so we talk about fair market value, and then we talk about fair value or fair valuation. Okay, so moving here to this point, fair value is a term we use. It's a term used when price trades with speed through an old high or old low, right? So it's leaving behind imbalances, liquidity voids. All right, so let me take this off to make the visual come back to life. All right, now at this point, we're seeing price trade stops and efficiency, trades through stops. We're already expecting price to rebalance and inefficiency. Okay. Well, when we understand that this market seeks to offer fair value, it seeks to rebalance ranges. All right. If we look at this delivery like this, let me use this right. If we look at delivery like this, right, this is an up close. Say this is up close or upside delivery, followed by downside delivery. Okay. This point right here is where there's fair value. All right. So we'll see the market reprice back up to that particular area. All right. Once price reaches fair value, okay, as we mentioned earlier, price will trade discount to fair value, right? Fair value back to discount. Discount to fair value, change in stated delivery back to discount. Okay. So this is where we say, hey, order blocks are created in areas of fair value. Why? Because if the market is fair at this point, if everything is fair, then there's really nothing else for price to do, right? It's time for price to leave the range. How do we leave the range? We change our stated delivery. Well, what is a change in stated delivery? It's an order block. Order blocks are formed in areas of fair value. All right. To get more in depth, once again, at this area, instead of taking this fair value gap for face value, we understand that there's going to be a certain response. For price to trade from point A to point B, there has to be bullish order flow. For price to trade from point B back down to here, point C, there has to be a shift in order flow, changing into bearish order flow. All right, but it all starts with your high probability pricing sequence. We're up here. We'll see liquidity engineered, liquidity taken. We run through here, right? This is would be that last phase reaccumulation. And this is our first change in stated delivery. Okay. We don't always have to execute here. A lot of times in our minds, what we think about price, this rarely happens. It will happen, but it rarely happens. What we think about price is that, oh, price is just going to do this. Then it's not until you actually get into the trade where you want it to do this, and it does the complete opposite. It takes forever to reach your target. So my point is understanding that there is a multitude of opportunity. Why? Because price, oh, not this. There's a multitude of opportunity because price is going to trade stops and efficiency, stops, efficiency, stops, efficiency, right? And at some point you might just get, just straight up speed, all right? So we don't always have to execute at the smart money reversal. You don't even have to execute at the first OTE, right? You can see price as just simply buy and sell programs where I want order flow to be confirmed. All right. So seeing this as upside delivery, this is basically how we should view price. Up close candle. This delivery once closing through the bodies of the series of candles, down close candle. Now I want to see how does price now respond to this. There's two things that can happen. After we take out this low, so we tap into higher time frame PD array, we take out this sell side liquidity pool. When the liquidity is taken from the last phase of reaccumulation or the last phase of redistribution, this is the finest area in price. Why? Because I can now see that is this move a move that is made solely to refuel the next expansion or not. If it's made to refuel the next expansion, then we'll see something like this, small little run, and then boom. Right? But if this initial order block is the first establishment of a change in order flow, then what we will see is price retest that order block and create a failure swing, which in turn becomes a few things, right? See price like this. We ran up, we create short-term highs, we run up, create intermediate term highs, we run lower, clearing out the first liquidity pool. We trade back up and back down, creating a failure swing, which also creates your second change in the state of delivery. Up into that candle, down into that candle, right? There's so much that can be done here. Think about it. This is the only time I'm going to be time frame specific. Let's imagine you were looking at this delivery on a 4-hour time frame, okay? And you saw the 4-hour up close candle after meeting PDRA followed by down close candle that creates that first change in state. And then you saw another 4-hour candle, right? And another 4-hour candle that creates the second change in state, all right? And now you're coming into your London session, okay? Right? Or even your New York session, and you're an intraday trader. Well, you already have a great insight as it relates to the higher time frame, right? The higher time frame order flow. Order flow is truly established. So I can play this range with pure confidence. All right. I don't have to trade on the 4-hour. I can be on my lower time frame, right? I can trade intraday, whatever my intraday model is. But I have understanding of the overall framework that gives me confidence behind this move. All right. This here might even be midnight opening price, right? Where there's a Judas swing right here. And you're super confident in that move. All right. Okay. So we talked about balanced price ranges, fair valuation, right? Fair valuation is price trading with speed here, here, right? Trading with speed through a particular area. Only sell side delivery is offered from this point to this point. Oftentimes, we'll see price trade up to fair valuation, and then we'll get back away. All right. Just to show you a clear example from this is Euro USD. Actually, we'll just go to the chart on the 4-hour time frame. Right. So prime example, right, of price trading into fair valuation. Buy side was offered here. Buy side is offered here. Sell side is offered here. This is a point of fair valuation. Price trades back higher. Doesn't reach it here, right? But overall, this is the initiative. Once we reach fair valuation, what should we be looking for around here? What should form around here? All right. What are we looking for to form around here, guys? Yeah, change in state of delivery, order block, right? But essentially, overall, a high probability pricing sequence. Yes, great job. All right, because the move from this point down here, A to point B, right, that's going to create a buy side of the curve, right, which should be followed by the establishment of the sell side of the curve. Okay. So maybe we go into a, all right, so, I mean, it's pretty clear here, but yeah, same idea. So we engineer Okay, and we engineer in the form of a balanced price range, right? Everything, price is going back and forth, right? Everything is balanced, it's efficient. This is fair market value of that balanced price range. Okay, we trade up into fair valuation, right? If we were to get more fractal with this, right? Then we see the order block established. So watch this right here. Move this out of the way. All right, so if I were to go to a 5-minute time frame, you can see it. But we trade up right here to fair valuation, right? We see speed away. Okay, engineer, neutralize, distribute, right? Price rebalances, redistributes. So we talked about that cyclic nature of price, right? All of this is buy side of the curve, which is transitioning to sell side of the curve. Okay. Engineering here, neutralize, distribute, rebalance. Well, guess what happens with this range? It's the same thought process. It starts over. So even though this is the rebalancing phase of a larger fractal, where you're getting a short-term high, an intermediate-term high, price trades away with speed, and it comes back up to create the other short-term high, the fractal repeats itself. All right, let's dig inside and see how this fractal actually repeats itself. Okay, so even at this point, right, we reach up into fair valuation here as well. Okay, and then we go back through the same thing. Price engineers a high, takes the high out, engineer, neutralize, distribute, rebalance, redistribute. I want you guys to tell me, where can you execute on this? Right? If we were to go first, mark out the very first change in state of delivery. You guys can mark on the screen. David, stop cheating, bro. All right. So that's the very first change in state, right? This is where price closes through the body, right, of this candle. Okay. Now, this is the context that's provided. Okay. You get a sweep, you get this move here. All right. Now, absolutely. Now, we just swept liquidity because this move below that low is just essentially a sweep of liquidity, right? Or first change in state. But where can we be more confident in terms of an execution? Whereas this execution becomes duplicatable. Absolutely. All right. So we already know where we are in terms of a larger fractal. Okay. We know that we hit a PD array. Price went through its phase of engineering, neutralizing, right? It distributed. And now there's a rebalancing phase, which essentially is restarting the overall fractal. Okay. So up here, we're going same thing. Engineer, neutralize, distribute, rebalance, redistribute. Your second change in state, which solidifies order flow, is once price closes through the body of this candle. Boom. Even at this point, it's still not a bad execution. Why? Because terminus is here. All right. So my whole goal is to prove that you don't have to fight to get the most precise entry. You don't have to time the market at the most pivotal point. Why? Because if order flow is established, it's going to show that it's established. Okay. So at this point, we could execute here, right? Or we could also execute at this point. Okay. And essentially, these are just Model X rules. Okay. And then from there, we see speed. So you guys see this move right here, high resistant liquidity run. Whereas this move here, low resistant liquidity run. Right? So which direction are you going to have an easier time sitting in? The low resistant liquidity run. Wow, there's more speed. There's more initiative to send price lower. Okay. So it just pays just to have that brief insight in terms of, hey, am I the high resistant or low resistant liquidity run? Is a parent order flow bearish or bullish? In this case, we already know parent order flow is bearish, right? We can see it up here. I'm going to have easier runs to sell side liquidity, tougher times trading into parent order flow. All right. So just looking at additional examples of fair valuation, right? Price trading with speed through that area, trading back up, right? Meeting fair valuation and then trading away. Okay, you should be able to see the fractal of engineer, neutralize, distribute, right? Trading through that low, rebalance, redistribute with speed. This move from point A to point B to point C, market maker model. This move from point A to point B to point C, market maker model. All right. Same idea. Now, this is just showing a balanced price range here, right? Price trading up to fair market value of that balanced price range. All right, then we trade away. Another example, balanced price range. We take out buy stops, we take out sell stops, and then right here, fair valuation. All right, another example here. And also another example here, right? Okay, so that is fair value, fair valuation, right? And then also your balanced price range, okay? Now, just going back to the balanced price range, I kind of already mentioned this, but the whole key point about a balanced price range is that we see a range of price efficiently traded, and then price trades through that range from one side, and then it flips the script. All right. When this happens at PD arrays, this is the better sign. Okay, because it's not gonna play back and forth between this. It's either it leaves this way and it continues, or if it leaves this way and reverses, then this is the true direction. All right, so just a few examples here. Balanced price range, we leave with speed this way, and then boom, we change direction. All right, changing state here. Balanced price range, we leave with speed this way, and we change direction. You can see fair market value of that BPR here. All right, it acts as support for price. All right, tons of other examples. Here we are, fair market value, speed through that area. Okay. We don't need price. Why does price not really come right back here right away? Right? It doesn't necessarily need to. And I don't want us to get into the habit of trying to be that precise or be that algorithmic. But the reality is everything is efficient here, right? We lead with speed, okay, and it creates kind of a breakaway gap, right? Because everything is efficient right here, right? And then once price does come back, look at where it comes back to. Fair market value, 50% portion of that balanced price range. Okay. This also goes back to the concept, right? Everything is always going to point back to the concept of power of two, or the second change in state of delivery. All right. So if you guys look at these series of down closed candles, this can be seen as my order block. All right. We clear out that series of down closed candles and we close. These down closed candles, right, retest this down closed candle. Right? And then what occurs? A second change in state. All right. Now the timing here is, it looks like it's getting later in the day. But you can just see the confirming of order flow. All right. So that few examples here. Okay. Now, just bringing all of this together, all right, which we've kind of already done throughout it, but in bringing all this together, right, essentially here's where we kind of put all the pieces together, right? We understand why a dealing range's delivery, right, is so significant, or a high probability pricing sequence's delivery is so significant. And the reason being is because it's a compilation of blending institutional order flow with balanced price range theory, fair market value, and fair value. Okay, it is the change in state of delivery. Okay, and if we simply just understand that this market is just a compilation of buy programs, sell programs, buy programs, sell programs, right? Reaching into a higher time frame PD array before it transitions over. If we just see price through that lens, and all we have to do is get very good at knowing when order flow is truly established. All right. So you get your initial high probability pricing sequence, buy stops taken, sell stops taken, right? And then you see how price actually responds to that delivery. So in reality, it's the rebalance, redistribute phase that becomes most significant, because that phase is what creates or finalizes the swing high. Short-term high, engineer. Intermediate high, neutralize. Distribute. Now the need to rebalance and redistribute, rebalance, redistribute, creates a swing high fractal. Second change in state of delivery, right? If we can apply this approach every time and understand, once we put together and understand order flow, understand bias and direction, right? This is the simplest approach that you can take. Literally. Okay. So a dealing range, and I don't want to spend a lot of time on this part, but a dealing range is simply a sweep of buy stops and sell stops. Okay. Why is it important? The reason that part is important is because earlier we talked about the fact that when price is trending, price trade stops inefficiency, stops inefficiency, stops inefficiency, stops inefficiency, right? It's a compilation of buy and sell programs. This is a sell program, right? Trade it down, create another sell program, trade it down, create another sell program, okay? Now, this might be the high resistant liquidity run. Price trades into a higher time frame PD array. Now, as a trader, it's my job to speculate and to see if the current moment's order flow, which is bearish, realigns itself with the higher time frame order flow, which is bullish. All right, down close candle, support and price. So the very first sign that this lower time frame order flow reestablishes itself to align with higher time frame order flow is the dealing range. A dealing range is a sweep of sell stops and buy stops. Okay. More prominent if that occurs after reaching into a PD array. What that shows us initially is that price was once in a cyclic nature of trading stops and efficiency, stops and efficiency, stops and efficiency, stops and efficiency. And it traded stops. If we're bearish, we would go inefficiency stops. But the fact that price goes stops to stops, there's something significant. There's a change. It creates a dealing range. We go stops to stops, and then it should if order flow is bullish, if this is aligned with the parent order flow, it should give us a move back down into the range, inefficiency back to stops. Or we can say second change in state of delivery. right? So this is why we're waiting for that down close candle, up close candle to close above the down close candle's opening price, and then another down close candle to retest it and trade back above that down close candle's opening price. At that point, order flow is established, and we should see an easy low resistant liquidity run to the terminus. Okay, so a dealing range is a sweep of sell side liquidity, buy side liquidity, creating inefficiency, rebalancing inefficiency, and then redistributing. Okay. On your PD array matrix, what this creates is an order block, fair value gap, old high. Three most significant arrays, right? The order block that once rested here, right? It just changes roles. It now becomes a breaker. Okay. This move here, what we're looking for. So keep this in mind. This should be a note. When price takes out the initial or the you know the high that actually led to the low, right? Which is that is your last phase. What we want to see, what you're looking for is a failure swing, right? So when price runs out this liquidity pool right here, to really solidify direction, to ensure that this isn't just a liquidity sweep to go lower, what you're looking for is a failure swing. Boom. That creates a failure swing, which creates a swing low fractal, which creates a second change of state equilibrium, which creates the establishment of order flow. All right. And higher probability chance at getting direction right. Okay. So just to go through the visuals down here. This is that image. Maybe I'll clean some of this up. Okay. So we'll go through this last little part, and then we'll dig into questions, right? I want you guys to challenge me as your mentor, right? And ask whatever you feel is your deepest question about price. Is anything that does not make sense in price, or anything that does not make sense that I've said today, right? Challenge me, make it make sense. All right. So right here, what I'm showcasing to you guys is this is price moving once again in its cyclic nature. Okay. We have parent order flow where down close candles are supporting price. This could be a 15-minute chart scaled down to a 3-minute time frame. This could be a monthly chart scaled down to a 1-hour time frame or a 4-hour time frame. The point is the time frame does not matter. What matters is that you understand order flow, right? The relative nature of the candles is all going to be the same across all time frames. All right. So price, at this point, this would be our high resistant liquidity run, which means that we're prepared. All right. We're prepared for a low hanging fruit approach. All right. We're not expecting price to run to the opposite end of the range. And that's also another reason why you want to identify is this the high resistant or low resistant liquidity run. Okay. In this case, we know this is high resistant. I'm not expecting price to run here. All right. This is not where you're going to take a higher R approach. Maybe 1.5 to 2.5 R and done. All right. Now, this way is the high resistant liquidity run. I'm expecting an extended price run. I mean, the low resistant liquidity run. I'm expecting an extended price run. Here, we see price engineer, neutralize, right? Distribute. So it's always one for the newer guys. It's one, right? Which takes out the buy stops. Two is where we run out the sell stops. Okay. One, take out buy stops. Two, take out the sell stops. Okay. Now, engineer, neutralize, distribute. What needs to happen next? What happens next? Yeah, we need to rebalance and redeliver. Okay, so we need to rebalance. So price is just taking external range liquidity. Now it's going to seek out internal range liquidity as a form of rebalancing this range. Okay, so we trade up. There's liquidity pool. Okay, now that we have rebalanced the range, what is our thought process? Because the order flow from this point here to this point on the lower time frame is going to be bullish. So what is my thought process? Yes, I need to high probability pricing sequence. Let me identify a change in the state of delivery. Can I also look for a second change in state, right? Can I go by like power of 2? Absolutely, right? It should give me a little more confidence. Okay, so we're inside of here. Price is at that PD array. We engineer, we neutralize. Okay, I have a not really a trick question for you guys, but I do have a question. All right, so let's say we go here, right, and we put in this little failure swing. Is price ready yet? Circle your last phase. I think it's Enzo. All right, we've just gotten a failure swing. We've just cleared out. I mean, this is a structural point, right? Exactly, right? So we have layered liquidity, right? Exactly. I like the way you put it. That's internal structure. Okay, it's internal structure. This is the official last phase of reaccumulation, right? I'm not looking at this as a structural break. Why? Because this is the order flow that led to this high. Okay, so if we zoom out a little bit, and not necessarily zoom out, these down close candles are still supporting price in the lower time frame that led up into this range. Okay, so this move here can just simply be, if I rush the move, this could just simply be a liquidity sweep and then price moves back here, respecting the down close candle. All right, a lot of people get caught up with this a lot, a lot of different times. So once I see price trade through here, boom, we trade through here, clearing out the liquidity. All right, we trade back up, second change in state. Now the move is super solidified. Okay, super solidified. Actually, I'll leave the chat up. I like seeing you guys' points. So now this point is super solidified. Now we're expecting price to trade here to this target. But how would I manage this trade? Right? Because this is a high resistant liquidity run. Okay. Now my PD array is here. All right. So how do I want to manage this trade? Given that this is the high resistant liquidity run. What would you guys do here? Don't all answer at once. Okay, so yeah, so what I'm asking is how would you manage this trade given the overall framework? Given the overall framework, how are you going to manage the trade? Right? Are you going to anticipate an extended price run? Are you going to take low-hanging fruit? Are you going to take a bulk of the trade off here? Right? Maybe leave a little bit to run here, or are you going to leave a full portion on to think that price is going to keep going down here? Right? In this case, exactly, not leaving full portion. Why? Because this is the high resistance liquidity run. It goes back to the scenario that we opened up speaking about with the Nasdaq. understanding that this move right here, right? This was the high resistance liquidity run. Once we hit the PD array, right, we should be fully out, right? Or maybe even out a decent portion prepared to scale out of the position. Okay, simply because this is the high resistance liquidity run. Okay. Low resistance here, which is why we got speed. Created low resistance signature, right? This is done on purpose. Easily taken out. Okay. Going back here to the visual, right? So basically here, we'd want to be out most here, right? And then even more here, but we're not expecting an extended price run. Okay. So price trades down. We've identified our second change of state, right? Price trades down, 50% grade. What do we expect at the 50% grade? No, not retracement. Yeah, right. We expect price to slow down a little bit. All right. This is that offset reaccumulation, offset redistribution. By saying offset, all we're saying is price is just going to give me that high probability pricing sequence. Engineer liquidity, take it out, boom. So you're seeing, to make it more clear, at the 50% grade, what we expect is a high probability pricing sequence to happen even at the midway point of the pricing week. Right. So when this happens, right, you can see order flow is established. All right, order flow is established. We get the run, right? Price takes out. We go stops and efficiency here. Boom, right? We take out stops. Boom, we go here. We hit the PD array. This is where a lot of people get caught up. They're not understanding framework, and they say, oh, buy stops, sell stops. I want to short. All right. Why is probability decreased at this stage? What should we be looking for at this stage? A shift in order flow, right? High probability pricing sequence to the upside. Absolutely. So instead of me seeing this run below these lows as a structural shift, now I flip my perspective. The paradigm changes, right? Now I want to see this as just a short-term low, right? It's just a short-term low. I'm seeing this move as a potential intermediate term low, right? I'm looking for a swing low fractal. I'm not looking for continuations lower. I'm looking for the order flow seen here. I'm looking for this order flow to shift. I'm saying price shift back into alignment with the parent order flow. And then as you do it, give me a second change in state of delivery so I can really confirm. All right. So what that looks like is price might go here. It might go here to give you a reaction. You're happy. And then boom, speed. And like, wow, I was really counting on the 2022 YouTube model. Right. But you didn't understand that higher time frame framework has to approve this lower time frame context. So we trade through here, clearing out last phase of redistribution. Okay. Once we clear it out, it creates this down. Boom. Okay. Right. And then what's expected next? Engineer, neutralize, distribute, right? As Chris stated, the other short-term low is expected, which is rebalance. Okay. followed by redistribute, which in turn can be communicated as second change in state of delivery. From there, order flow is established, down close candle, support price. We should expect speed. Low resistant liquidity run. All right. So let me make sure there's not anything I left off. Because then what we'll do is we'll phase into questions, right? Q&A. This is just showing you guys multiple scenarios, right? Engineer, right? Run out previous day's high, trade below, right? Rebalance here. But then also this becomes even a larger fractal. There's 1, there's 2, there's 3, right? There's 4. Okay. It happens again. 1, 2, 3, right? And then 4. Okay. So key point, something I did forget to mention in teaching this. The way I always teach this is this. One, 2, right? 3, rebalance. 4. 4 should always take out 2. Okay. 4 should always take out 2. But what happens if 4 doesn't take out 2? Let's say that 2 occurs at a higher time frame PD rate. And 4 trades down inside of the range. 4 fails to take out 2 and instead takes out 3. But it increases probability that 1 is going to be taken. Why? Because order flow is just shifting over. All right. So then what we do from that, if this happened from a higher time frame PD array, what you do is you see it as this. Now roles reverse. This becomes 1, 2, expecting this range to rebalance and then redistribute. Order flow has shifted. Okay. All right. We'll answer this question. Yeah. 1 becomes draw liquidity. Exactly. All right. So I want to transition now. Okay. Today, as mentioned, today is laying the foundation, right? This is more of a instant type of boot camp, right? It's not like a 4-month deal that we usually do. So this would be more so about getting into actual models, things that are duplicatable. We'll spend more time there. But as we're going into these models, it's more so us truly understanding the market is just buy and sell program. So let's begin to shift our lens to see price from the stance of buy and sell program, and then also understand that, hey, yes, we know that there are advanced entry techniques, right? We teach them, we know them, but if it doesn't fit your mold, then stop forcing yourself to trade in that way. All right, because there's a lot of proficiency that can come behind the second stage OTE, right, or second CSD, right, which I call power of 2. Okay. All right, now questions. Let's see. This will be provided. So you guys will everyone on this call will be in the materials channel. So you'll see this recording and every other recording from here out. All right, so questions. Feel free, you guys can turn off your mic and ask questions. I prefer my older guys to, let's let the newer people ask questions, unless you guys have a question that you are very sure is going to reveal more understanding. So you can either put it in the chat if you're too shy, or you can just ask away. Yeah, David, I know you're coming. This material provided in the Discord group. Send it there. Okay. All right. So I'm not sure about the abbreviation on fair value and fair market value. I understand what they are, but never which one is which. One of them is a break of structure gap. So no, not that. Don't worry about that. And the other one is premium and discount. All right. So um my main philosophy when it comes to these concepts is don't get caught up into the semantics, don't get caught up into the term itself, right? Because price has always existed before any type of term. Exactly. You know it. The thing exists without the term. So let me speak about or clarify what these are. All right, when we're talking about fair market value, fair market value, what that has to do is that's just our way of distinguishing between the midway point of a balanced price range. All right, so if you look here, if price is going back and forth, okay, and we leave with speed, what we're saying is what we're saying is uh fair market value is this point. Okay. It's the midway point of a balanced price range. Okay. So you got to first really make sure you understand what the balanced price range is, which is just buy side and sell side is evenly distributed. Okay. Within one area of price. Right. And then price will spend a little bit of time within that area. So the fair market value is the midway point of that area. Does that make sense? Okay, perfect. Now, let's incorporate fair valuation into this. Okay, so let me give a clear drawing. All right. Okay, so let's say price is here. Okay, and it leaves this way, right? And then we see speed this way. Okay, so fair valuation is price. All right, thanks, Chris. Uh, price trades down, and then we trade up. Okay, so fair valuation is the point in price at which there's only buy side delivery. All right, the market will offer fair value, right, to certain participants. Okay, so let's say that that created a high. Just visually, or the way you internal not visually, but the way you internalize this is basically what we're seeing. Right, everything is fair here. Right, nobody's out leveraged, if you will. Okay, so the market in market sense, what happens is this becomes our point of fair valuation, and then we'll see price trade down, coming down back into this point, right? Reaches fair valuation, and then we expect to go back through the same fractals, shifting to the buy side of the curve. Mm-hmm. All right. Next questions. Please ask away, guys. Like, don't give up the opportunity to ask a question. Ask your most challenging question.
All right, so I have a question about like the open high low close of like the larger time frame, right? So for example, let's say we're on a weekly time frame, right? And price is coming back into like a weekly order block or a weekly inefficiency, and then on the weekly time frame, it closes on that like on the PDRA like above the 50%. The next open is that like where we would kind of expect price to hey create the wick and then go into the buy or the sell program or whatever it is, depending on which side of order flow it's on, if you get what I'm saying. And then like
Mm-hmm.
on the lower time frame, we'll kind of see it like align with order flow as it starts to kind of unravel the candle and print upwards or downwards and Basically, you see what I'm trying to say. Basically, though.
So all right, so let's draw it out so that everybody can follow. So these are your weekly down close candles, right?
Yep.
All right, and you're saying that price trades down into these candles.
Yeah.
All right, and what happens next?
So basically, what I'm saying, like, what happens next is like, if basically the PD array, or not the PD array, the PD array gets respected, like, by the, let's say, for example, okay, we're looking at a weekly time frame, and the weekly candle goes back into the weekly order block, right?
Mm-hmm.
And then it
Mm-hmm.
closes on top of it. Then
Yeah.
the next week it opens. Do we expect it to go into a buy program from that open? Basically.
So perfect question. So basically, that this weekly candle has just closed, right on top of these weekly candles that are essentially
Yeah, basically, right.
Mm-hmm. Yeah. So basically, what you're asking, let me make sure I draw this so everybody can follow. All right, and then you just started seeing weekly down close candles. Maybe there's two candles, right? And they trade and it closes right on top of this.
Right.
Okay. Now remember, it's not about the candle, it's about the delivery. Okay.
Right.
So even when we come to the next week, I'm not as concerned with this candle.
Right.
Okay. What I'm concerned with is the lower time frame delivery. So if we draw out the delivery from this candle, right? Let's see what that delivery looks like on top of this candle. Okay. So go here. Okay, and I'm gonna draw the delivery over here. So let's say we come down, right? And then this is the opening price of that candle. This is the opening price of that candle.
Right.
Wait one moment, I gotta get my drawing tool right. All right, so we trade up. All right, we trade down. Okay, maybe there's a short-term low created, but we trade down. And then price trades up and it closes. Okay, so that's the candle, right? Open, high, low, close.
Right.
Now, so my point is, it's not about the candle. It doesn't matter about the candle. What matters is higher time frame higher time frame order flow is still intact. So I don't care about the candle. I don't care about the visual of the candle. I have to see beyond the candle. I have to see the candle inside out.
Makes
Deliver,
sense.
open, high, low, close. So the next week, okay, the very next week could very well go open. I'm sorry, this is open, high, low, close. The very next week could very well go open, low. It could take out this previous week's low. So
Yeah.
it could look something like this. We can go open, right? It could trade lower and take out that previous week's candle, right? And then begin to trade higher. You see? And so what the delivery is going to look like when we view the candle inside out is you got price going here, here, right? Maybe a Tuesday low of week, and then we get an expansion. Boom, right? We just took out liquidity and then we closed. You see? So we just took out kind of like that last phase of redistribution, which would have been this high right here from that candle.
That makes total sense. I
Mhm.
always wonder that too. Yeah, that's why I wanted to ask it. I was like, because like I would see it sometimes, and I'd be like, or get annihilated, and I'm like, what is happening right now? So yeah,
Yeah,
for sure.
yeah. So, main point, just it's not about that. It's not the fact that the candle closes here. It doesn't matter what that candle does. What matters is that these guys are still intact.
Still intact. Right.
And we're looking at delivery.
Right. Yeah, I guess kind of where my thought process was kind of asking that was like basically saying like does the respect of that down close candle like really solidify like or like kind of project the next candle that comes into play, if that makes sense?
Nah, I wouldn't. Nah, don't
Right.
do that because there's not going to be any type of statistical approach that you can take with it,
Exactly. Yeah.
because just because the candle was closing here, I mean that doesn't it has nothing to do with
Nothing
it.
to do with it.
Yeah.
Gotcha. Okay, makes sense.
Yeah.
Thanks for clearing that up. Appreciate that.
Yes, sir. Next question. Yeah, exactly. So what I mean by this, Enzo, if I'm saying it right, is I'll give you a scenario. We have PD array. Okay. So we got PD array. Price trades down. Remember that this is not time frame specific. This could be a 30-second chart. This could be 5-minute PD array, 30-second chart. Okay. The if price is gonna go from here to here, Enzo, order flow, order flow is gonna say for this time being, up close candles are gonna support price. Okay. Now this is the part that I'm speaking about. Okay. It is not. Let me zoom in. It is not this structural point, right? As my guy mentioned earlier, this is like internal structure. It is this structural point, right? So when price turns around, say we go here, and let's say we clear out this point, okay? If you want any type of objectivity in terms of how you view and engage with structure, all right, you should implement this approach. Whereas you really define what structural point you're going to utilize and what structural point has the most validity. And it is that highest point that led to the newest low in this case, and vice versa for other scenarios. So I'm not gonna take this as, oh, that's a structural shift. Right? There's a structural shift. Now I'm prepared to trade a PD array inside of here. Right? That's the best way to get caught in a move too soon. It's this structural point. All right. So I have to view this as my last phase of redistribution. So now, once we trade above, okay, we trade above this old high. We trade above that old high. And this is why a lot of times you guys, like when I'm doing the weekly outlook, I'll say, okay, this daily chart or this 4-hour time frame, we just traded down into this weekly fair value gap. Okay. And I'm looking at the daily chart, and I see that price has traded and closed above. And you guys hear me say this all the time. I say price has you're fine. Price is traded and closed above. And I'll say, all right, what I want to see to really confirm, guys, I don't want to see another daily down close candle traded to here. All right. You know why? Because if order flow is truly bearish, it'll prove to me that this move above these highs, this move here above these highs, wasn't just a liquidity sweep to go back lower. What will happen is it will show me another change in state of delivery, right? Balanced price range, balanced price range. Doesn't care about the sell stops, right? We're after buy side liquidity. Okay, so taking this off, second CSD, we push here, first, trade down into the order block, second CSD here. From there, order flow is confirmed, speed. All right. All right, next question. You're welcome.
Yo, Chris.
One second, let me
Oh,
read
okay,
this.
yeah, let him.
Sometimes the market rises but doesn't come to retest the down close candle. I'm glad you asked this question. So sometimes, keyword sometimes, the market rises but doesn't come to retest the down close candle. It creates, and I'm lost when that happens. Okay. Now, you just stated sometimes this happens, which means that sometimes the other part of that equation happens, right? So what you should not do is change your standard operating procedure for the sake of sometimes, right? What you should do as a seasoned trader is only abide by what makes you most comfortable, right? You just said that this leaves you confused. You're lost. That's not a comfortable scenario, which means you should not engage in it, right? So the scenario that we're speaking about, where it gives you a second change in state, it clears this area, comes down and gives you this equation. That's how you got to look at price. This provides you an equation. All right. Every trader should understand their equation, right? This equation might be something like this: circle, triangle, right, box, right? Basically, what I'm saying is these are the ingredient to this equation. And we know that this equation, this second change in state, has about, I'm going to go with what Ipta said, has about a 70-25% chance of occurring and working out. So what that means is 75% of the time is going to give me a positive outcome, but then 25% of the time, actually, for the sake of the next visual, let's do 80-20, right? But then 25% of the time, 20% of the time is going to give me a, what I would call, not even positive or negative, but let's just say a scenario that works out, a scenario that doesn't work out. Okay. So only thing I need to be concerned about is the random distribution that lies within this scenario. So what that's saying is, hey, 20%, or sometimes, as you framed it, sometimes it just ain't going to give me that. But 80% of the time, it's going to give me that. So what you should not do is allow the 20% of sometimes to cause you to change the equation, right? Because you're looking for certainty. You're looking for 100%, right? What's the scenario that's going to happen 100% of the time? There is no scenario. There's no answer for it, right? The true answer, the season answer is focus here, all right? So if it happens where price says first change in state, right? And, maybe it just runs away, so what? That's just one scenario. The moment you try to find the solution to this, your mind boggles, right? Because you're searching for certainty and it doesn't exist. You're searching for something that just does not exist in the art of trading. Everything we do is for the sake of probability. No ICT concept has a 100% chance of working out every time, right? And even if you get the 20% twice in a row, it's just random distribution. You never know when this is going to show up. All right. I hope that gives you some perspective. Okay. Yeah. Because if we could sit on here for days and talk about what scenario is going to work the best, and then you'll never really find one that gives you a concrete outcome every single time. Next question. Great question, by the way, though.
Okay, so Chris, basically, you spoke about something that now that I see it, I literally went to the chart and seen it. If you want, we can look it up or not. It's just literally on euros, like
Yeah, let's do it. Let's do it. I'd rather do
Euro
that.
USD is literally the same thing you just said. And yeah, if you go back maybe 4, it's like way easier to see the fractal high.
Well, let me say one thing. All right. This is essentially what we're talking about right now. Okay. You see there's a liquidity sweep, right? So we take out the liquidity, right? We trade above, we take out structure, and there's fair value gaps inside of the range. Okay. Well, I don't really know if this is just a liquidity sweep. Okay, now I'm seeing this type of context. Take out the low, take out the high, fair value gap. All right. But I can gain more confidence if I say, all right, let me allow price to do this. Give me second change in state to really confirm that the order block here is holding. Doesn't happen here. Now we're starting to seep back down towards the low of this candle. All right, so somebody got caught up into this move today. All right, I'm sorry, David.
No,
All right.
actually, if we can go on NASDAQ daily chart, that's way easier, way easier. Like it's literally straight up at our faces. Yeah, it's like literally right now. So basically, this would be my, so we all know that there's a, from your weekly outlook, there's a weekly fair value gap. I mean, a monthly fair value gap, the market hit, and we can see it go up nicely, but this would be your last phase of reaccumulation. We still,
Yeah,
so basically on the daily chart, I can't really say, oh yeah, yes, even though I see this down close candle support price, I can't really say this up close candle is negated.
yeah. So now look, this
Oh, sorry, let me wipe it.
this is actually a scenario you got to be careful with, because you see this. This is in
Yeah,
this is
exactly.
this structure is really inside of this high,
Oh yeah, right.
right? This is no different than this. It's boom, boom. All right, so let me go this high, right? So it's not this structural point, it's this structural point. So now that doesn't mean that price it's not it can't be valid and keep going. It doesn't mean that. I'm just, the point that I'm making is from a sample size of scenarios and giving yourself the best chance at solidifying direction, right? The approach you take is identifying the true last phase of redistribution, of reaccumulation. Now, this scenario, if you going by that, it might cause us to have to make a sacrifice, right? Simply because of the proximity of the last phase to where we know the ultimate terminus is.
Right.
That's going to happen.
The only reason I asked for this because it's a complex example, and and like I just showed, I showed that high when it made a whole lot of sense for you to show, obviously this one.
But no, you're on the right track. You're on the right track though. It's just this kind of can trick you because it looks nice, it's inside of the range, but it's no different than if we were on a 5-minute chart, and you saw this, right, and you took this structure point. It could very well do this. Just like this could very well go here, take out this high, and then go back here. Now we know the higher time frame order flow is open, low, high, close on the monthly chart. So it's probably, this price action is more prone to keep taking us higher as we projected. But just giving you the more objective approach.
Oh yeah, you're right. I completely forgot about the higher time frame. You're right. There is the down close candle. Yes.
Yeah, so this monthly down close candle, right? Fair value gap, monthly down close candle, right? Down close candle here as well. Okay. Now, if you were taking like a 4-hour time frame approach, all right, seeing price close above here, right, in terms of like a second change in state, right, after we've cleared out this and we've traded back down, right? So if you're only looking at the 4-hour, if you're only looking at this price action right here, and you were seeing this as a market maker buy program, right, and you were going sell side of the curve down into a monthly PD array, buy side of the curve, okay, and then you notice, all right, this created that low, this high, that low. You say, all right, this is last phase redistribution. Okay, you can kind of see we almost come back to like fair value. So we create a short-term low, intermediate, short-term, engineer, neutralize, distribute, rebalance. Now we're in that redistribution phase. Okay, even more
Oh,
fractal.
thank you. But thank you so much for this lesson. I'm not gonna lie, because I'm here like a dickhead trying to find something in here. This makes much more sense than what I'm trying to do.
Yeah, it's a battle with the ego in terms of the ICT space. You don't always have to. There's still room for opportunity on this move. You know, trading and closing above here, you can literally see price trades and closes above the opening price. You see where the retest comes from this candle, right? So, you know, I'd say it's higher in probability that we're going to run and take out these highs. Okay, and there's a lot that you can do with, you know, I guess that information or seeing price from that particular lens.
By the
All
way,
right.
thank you. I'm gonna go back test everything you said today.
Any other questions? Feel free. Candles that support the price. All right, to consider order flow, how do I get this shit out of the way? To consider order flow, do we only use candles that support the price, or do we have to negate the fair value gap and necessarily create some in higher time frame? All right, I'm trying to understand your question. To consider order flow, do we only use candles that support price, or do we have to negate a fair value gap? All right, yeah, thanks, bro. Thanks for joining. Let me see. I have to make sure I understand the question. Okay, so let's go. All right, let's say can you rephrase your question for me? Because I want to make sure I provide the right answer to you. Okay, so this is order flow. Down close candles are supporting price. Okay. And what you're asking is, do we only use the candles that support the price, right? These candles will support price. Or do we have to negate a fair value gap and necessarily create some in higher time frame? If only bearish candles support the price before even negating an opposite fair value gap, we're still bullish, for example. Yeah, exactly. So basically, if down close candles are supporting the direction of price, okay, and there's a fair value gap. Let's say there's a fair value gap here, okay, and price trades down and it closes that fair value gap. All right. This is not a sign that order flow has changed over. Okay. Now, rather we use the negating of this fair value gap as context for future price action, rather we use that as context or not, will depend on the overall framework. Okay. So what I mean by that is, if this scenario occurs in a market where, let's say I'm going to give you, let's say we're in this type of market where price is going stops to inefficiency, stop. We're on the sell side of a curve. All right. In the lower time frame, let's imagine this is the lower time frame price action that trades up into this range. All right. And then we're right here. Okay. Now we're already on the sell side of a curve from a more macro perspective. These down close candles that are supporting price, this is the high resistance liquidity run. So now I will use this as information to maybe take a more advanced entry, right? Which comes before a true market structural shift. I would use that information if it aligns with the higher time frame order flow, right? Or the sell side of the curve in this case. Okay, so if we trade and we close that fair value gap, let's say the fair value gap is here, we close it. All right. If you go and you look at the Model X entry model, if you're in the materials channel, if you guys don't have the link, I'll send the link out today. What you'll see is there's a more advanced entry approach where we use the fair value gap and the candle that creates the start of the fair value gap. We use this as our initial order block validation. Okay, and if you haven't watched that material, you may not understand fully what I'm saying, but we will use this start of this candle that creates that fair value gap, which we call our housing candle. We'll use that as the validation of the order block. And then we just go with the same execution here. All right. So it is a early and advanced entry mechanism, which doesn't require you to see that full structural point clear. However, right, the way that you engage with price has to be within reason of the current market scenario. Okay. Now, on the flip side of this, if this scenario is given to me, okay, if this same scenario is given to me, let's say this same fair value gap exists right here. All right. And I'm seeing down close candles that are supporting the direction of price. Okay. In this scenario, I am not going to jump the gun. Why? Because I'm on the buy side of the curve. Okay. Any type of advanced context that opposes what side of the curve I'm on, I'm not going to jump the gun and take it. Right. So inversion fair value gap, but hey, order flow in the higher time frame is bullish. So I don't care about the inversion fair value gap right here. I'm not looking for a reversal. I'm on the buy side of a curve. Price hasn't even made it to its terminus. Okay. So it comes with the nature of knowing when, right, and where to apply certain things. Right. Certain markets will require a more conservative approach. Other times you are able to use a more advanced approach, but you got to know when and where. I hope that answers your question. Perfect. All right, I'll take a few more questions and then we'll close out. And then I'll let you know. It wasn't on the schedule for tomorrow, but as I mentioned, I have some free time, so I kind of don't mind jumping on tomorrow and just having a more flexible call. All right,
So Chris,
questions.
I'll ask one last question. So
Yes, sir.
it's the same thing, like this image is perfect. So just because we see that weekly order flow is bullish, that means that even though if I go scale down to a daily M4, I'm seeing a sell side of the curve meeting a higher time frame, down close candle, and I'm just anticipating that it will support the direction of price.
Yes.
All
Yes.
right. Okay. That clears up so much of my psychology right now. I'm not gonna lie.
Okay. So that question you asked, okay, I wasn't going to speak about that today, but that question you asked is what I call operational delivery. Okay. And it's a topic that needs to be taught and brought up. Maybe we'll speak about it tomorrow in depth. But what you just mentioned is what a lot of people get caught up on. Okay. You start to see order flow transition on a certain time frame. Okay. But you don't understand that it's only transition on that time frame to the extent of more apparent order flow. So let me try to figure this out. All right, I know an example right off the top of my head. All right,
Yeah,
let's go
because you
back.
said it before, so I literally it glued to me right now. I don't know why.
let's go to this scenario on NASDAQ. This is back in August, okay? Now, you guys see how order flow is bearish right here? So let's first identify our monthly PD array. Monthly down close candles are supporting price, correct? So
Correct.
this is the parent order flow. At a certain point in time, weekly down close candles were also supporting direction of price. Okay. And then this weekly down close candle broke down. So weekly down close candles are no longer in support of price. Well, let's start this from the daily chart. Okay. The daily chart, the daily down close candles stopped supporting price, right? We cleared this daily down close candle. We clear out the daily buy side imbalances, right? And then we also clear out here, here, and then we clear this out, right? So now it's understood that from the daily time frame, all right, down close candles are inferior. Okay. The only way that the daily time frame candles can at some point become back superior is if the daily meets a weekly, right? So let's see what happens when the daily meets a weekly. Well, the weekly is here and we run right through it. Nothing happens. So now the weekly time frame down close candles are inferior. The only thing that gives them the chance at becoming back superior is it meets a monthly. Okay. So when I'm looking at this weekly fair value gap, do I think that price is going to turn around from that weekly fair value gap? No, I don't. Why? Because weekly time frame is proved to be inferior. This is operational delivery. In my mind, I know that this, from an algorithmic standpoint, this guy is who's in control. This is the only thing that could turn price around. Okay? So just pay attention to the diagram. Once we clear out weekly fair value gap, nope. Weekly order block, nope. What is it? The monthly order block. Monthly down close candle is what we trade into. Once we trade into the monthly down close candle, let me show you guys how you could be very tricked in this scenario if you're not understanding what's truly going on here. Okay, so I'm going to get rid of this and I want to bring up a daily chart. Okay. Let me go through this. All right, now at this point right here, have we made it to the monthly down close candle? No, we have not made it. So you guys see right here how there's a move lower, up, down, taking out liquidity, and then we expand higher, creating fair value gaps, right? Oh, isn't this 2022 YouTube model? Shouldn't those fair value gaps work? Not in this scenario. Why? Because we haven't engaged with the monthly PD array. Monthly PD array is the most significant. Okay. So there's context that's left out when you're looking at, oh, just 2022 model. Liquidity sweep, market structural shift, fair value gap. There's a lot that's left out. With this scenario, I'm not sold by this because of this. So up here, right? And you guys can literally go back and I'm mentioning this, but this wasn't, I wasn't sold by this. Okay. We turn around and then boom, speed right through this area. Guess what else guess what else is solidified here? We talk about second change in state. Okay. This is my last phase reaccumulation of redistribution. If I had a second power of two type of mindset or a second stage OTE type of mindset, right? I would see here, okay, we've cleared it out, created an order block. Now let me see if that order block actually supports price. Boom. Now it's solidified. But by not understanding that, you're caught up into just this lower time frame context. This is where price wanted to get to. Okay. So we run into that area. And watch this. We talked about high resistant liquidity runs, knowing when I'm at the point of parent order flow. This move right here, you're going to see engineer, neutralize, distribute. But what happens? Shouldn't it rebalance and redistribute? No, not at this point in time. Why? Because we have just made it to the monthly PD array, which is in control. Not the weekly, not the daily, the monthly. It's in control, which means any type of bearish lower time frame context that happens on this guy's time, I'm not taking it. All right.
Holy
Yep.
shit, bro. You made so much more sense right now. I'm actually gonna backtest. I'm not gonna lie, man. Like I think there's so much gluing you glued to my head today. It's unreal.
Mm-hmm. Let's finish. All right. So engineer, neutralize, distribute, rebalance. Why don't we redistribute? Because this is not where this should happen. What happens is, as I mentioned to you guys, okay, failure swing. Boom. We get a failure swing. Guess what? Even if you didn't understand that, if you had a second CSD approach, first CSD, we retest it. Do you ever get a second CSD? No. Never closes back below this level. ICT 2022 YouTube model, right? Liquidity sweep, expansion. Oh, let me trade the fair value gap. Not so fast. Boom. You left out narrative, framework. Okay, so now it's prepared to transition over, and now we see price move back into the buy side of the curve, clearing out the daily last phase of reaccumulation, of redistribution. See that? Now price is back bullish. Okay, so even though this idea, that little bit of teaching about operational delivery, which we'll continue to go more in depth, even though that this is on a higher time frame, you take those conceptual ideas and apply them even to your lower time frame. All right. Any other question? If not, then we'll close off. We've been on for like 3 hours. It's crazy. All right, going once, going twice. No. All right, cool. Thank you guys so much for your time. As mentioned, today was like laying the foundation. Tomorrow will be just a little more of laying foundation, but I don't want to be so repetitive because you guys have access to this stuff in the elite channel, in the materials channel. I want to speak more about trading models and just kind of reiterating what we should be looking for, how we should be executing. That's what this boot camp is about. So thanks, guys.
Thank you so much, Chris. Have a great day.
Yep. You too.